Good evening and welcome to Outlook 2026. It is Tuesday, February 3rd. I'm Bob Simpson, Vice President, Portfolio Strategy with Wealth Stewards, and I'm delighted to be your host this evening, this is actually our 6th annual Outlook webinar. Each year, our goal is fairly simple. We want to take a step back away from the noise and the headlines. We want to create a bit of space just so that we can have some clear thinking, maybe, look at some better questions and get grounded based on perspective. Tonight's discussion is going to focus in on 3 themes that are pretty relevant at the moment. What's driving equity markets, how private markets continue to evolve, and how recent tax changes may shape decision-making in the year ahead. We've also dedicated time for questions at the end. Each speaker has about 15 minutes, and at the end we'll have 10 or 15 minutes for questions. If you look at your Zoom panel, you'll see that there's a Q&A button. If you have a question anytime during the session, just press the Q&A button and submit your question there, and we will address them at the end. Now, we're fortunate today to be joined by 3 outstanding panelists, each bringing a distinct and valuable perspective. To start things off, we're fortunate to have Kieran Moore joining us from Melbourne, Australia. This is a very international event today. You'll see that one of our other speakers is joining us from India. It is 7 p.m. right here in Toronto today. At the moment, and it's already 11 a.m. tomorrow in Australia. So I thought that was kind of cool that we could actually have somebody speaking to us from the future to discuss equity markets and how they might evolve as we go forward. Now, Kieran is a partner and portfolio manager at Monroe Partners in Australia, where he's been with the firm since it was founded in 2016. He's actually our 3rd panelist from Monroe. We like their approach to investing. So over the last 6 years, we've had 3 people from Monroe. That just gives you an idea that we really respect their opinion on what's happening in financial markets. For the last decade, he's focused on global growth investing. Today, he is joining us to share Monroe's outlook on equity markets for 2026 and what's driving change. So, Kieran, thanks for joining us today. I think you just had the Aussie Open taking place. Isn't the stadium just down the street from where you guys are?
That's right. Thanks, Bob. Thanks for having us here today. That's right. It's just down the road. It's certainly a good time to be in Melbourne, although it's extremely hot, Bob. It's extremely hot. Yeah. So we've been having sort of mid 40s, mid plus 40, if you like, for the Canadians. So extremely warm for the Aussie Open.
Yeah, we've been having minus 30 wind chill. So, it'd be nicer to be where you're at.
Yeah.
So it's, to kick off with questions, your focus really at Monroe is to invest in companies that benefit from kind of the big lasting changes that take place in the world. I think you call it structural change. Not just, where I think a lot of what investors experience is a real focus on the short term. So with that in mind, just share with us what's your firm's outlook for 2026 and forward.
Yeah, that's right. Thanks for sort of setting that up, Bob. I mean, ultimately, our focus, our view is effectively to play that growth role in the portfolio. So we're about focusing on what the big structural thematics are in the world, and then investing in ultimately the companies that basically enable those big structural changes to play out over a long period of time. So we try and take long-term views around what's happening in the world, and effectively our job is to work out what's coming next. In terms of maybe bringing that back to 2026, Look, as we sit here today, I know that the year started in a slightly more volatile fashion than we probably anticipated. But as we sit here today, Bob, looking out at 2026, we're actually pretty constructive on the view for equities into the coming year. So, and that's really driven by, we think, 3 sort of major top-down thematics that we're looking at. The first one, I'm not going to get into the politics here, but the first one is really around. What we do expect is some support, I guess, from the administration in the US. So, when we when we started in 2025, we expected the current administration to, be in favor of tax cuts, be in favor of more M&A activities. So that's more mergers and acquisitions, more increased rollback of regulatory regimes, particularly in the US. More corporate friendly policies, if you like. And yes, we've had a lot of volatility, and we've had to focus on Twitter and Truth Social as to what's happening. But all these policies that the administration wants to get across are all good, and we think mostly on the whole, largely friendly for corporate America, and that should translate into supportive equity market policies as well. Now the one thing is that we've obviously got the midterms coming up later this year. We do expect more and more of this support for, I guess, the consumer in the US, the industrial base in the US, and ultimately any stocks that can participate in that support and the broader equity market as a whole. We expect to have some of that tailwind or benefit from some of that tailwind. So that's tailwind number one. I think if you think about tailwind number two in our view is all about the interest rates, the backdrop for interest rates. So the Fed has been pretty clear in their messaging around 2 cuts, the dot plot. Well, that's the forward-looking guidance effectively that the Fed puts out in the US. The dot plot suggests that we should expect 2 rate cuts in the US in 2026. So again, supportive for the equity market and supportive for equities. And then the third thing, Bob, and this is the biggest and most important thing, is that the structural changes that we see in the world today are starting to accelerate and continuing to play out in a major way. And the biggest one, I think, that's most obvious to people today, and I'm sure we'll talk about it in a moment, is that the AI story and the AI adoption, that is artificial intelligence adoption, is clearly playing out in the world around us and in the equity market. And so when you think about that, that's going to allow for lots of different opportunities for the companies that can participate and benefit and use AI to effectively improve productivity, improve efficiency gains, cut costs in their business. I think one good example that we often talk about is that if you look at, 2022, late 2022, when ChatGPT came along, got to 1 million users in 5 days, faster than Facebook did and faster than Netflix did and all these other great platforms that we've seen over time. Since that point when ChatGPT came along, the hiring growth, that is the hiring of employees, workers, engineers, technicians at the Mag 7, that is the biggest 7 companies, that is companies like NVIDIA, Microsoft, Amazon, Google, Meta, the hiring growth at those companies has significantly slowed. And I don't think it's any coincidence that hiring growth has started to slow right at the time when ChatGPT came along. And these companies, some of the biggest companies on the planet, were able to effectively start to leverage AI to create more and more efficiencies in their operating structures, in their cost bases. So that's tailwind number 3. AI adoption is real and it's starting to play out, and there's going to be lots of different businesses out there that can benefit from adopting this technology and using it to improve their business model. So in light of that big picture, those big picture tailwinds, that's how we're thinking about 2026. And in terms of how we've got the portfolio position to obviously benefit from that, we always think about the world, and we've certainly spoken about this in the past, Bob, but we always think about the world in terms of these areas of interest. These are our structural growth thematics, if you like, within which we're trying to invest in those enabling companies. So some big thematics for us for the portfolio this year, we continue to see lots of opportunity around decarbonisation, around climate change. Now, I know Nick has spoken about this on previous webinars with the Stewards Wealth team. That is a big opportunity, and we've seen lots and lots of demand for effectively improvements to providing power. So AI places a lot of demand on power. We've seen, a desire and a need to get towards net zero over time. So spending on companies that help provide solutions here to manage the power equation is, we think, a great place to look for structurally backed earnings growth. And then we've got a number of other areas.
It's interesting that I think it was in October, I was looking at ranking of the different sectors, and utilities were the second best performing sector in the US through that period. I think up around 22, 24%. And not something that you would normally expect in utilities, but that was really driven by AI, wasn't it?
That's right. So these utilities have seen effectively. So I'll give you a good example. We own a business and have done since 2022 called Constellation Energy, which is a nuclear operator in the US. We originally bought this business to effectively cater to nuclear playing a role as a transition fuel in the decarbonisation playbook that we expected to, happen over a multi-year period.
Mm-hmm.
We're not going to get all we need out of renewables straight away. For trying to achieve these decarbonisation goals globally. So we need transition fuels like nuclear. What's happened, and just to give investors an insight, is that the added complexity that AI places on the need for power for these big data centers that Meta and Microsoft and Amazon are all building means that that's provided an acceleration in the earnings profile for Constellation Energy and other similarly placed utilities that can provide this power at high capacity factors and low emission forms.
Yeah, no, that was really quite a surprise for me when I looked at those numbers and then thought it back and said, yeah, that kind of made some sense, didn't it? So, you've talked a fair bit about AI. AI probably is going to come through the market in waves. Is that kind of what you're seeing? That you're seeing,
Yep.
we ran some numbers on capital expenditures for, the Mag 7, as you described, and those numbers are pretty big. Where is that money being spent? Like where are they sending those funds?
Yeah, so there's a big demand here for compute power. That's clear. We understand that now. There's a big demand for compute power. Let's just take a step back. The demand for what these companies are doing, i.e. investing heavily in the data center to build out all this compute infrastructure, is basically so they can provide the best utility that we can effectively get out of AI. So let me just put that in context. If Anthropic and ChatGPT and Google Gemini and Perplexity, if all these models that we're going to start using and we are using sort of in our everyday lives at the moment, if they don't give us any benefit, if they don't make things easier or faster or more efficient, then we're not going to use them. What they've shown so far is that they do provide all of those really good outcomes. So these companies, the Mag 7 that you described, Bob, are effectively going to continue to invest, and they're going to continue to invest in a quite a dramatic way. So we saw Meta last week commit to somewhere between $115 and $135 billion of CapEx to be spent in 2026. This is a company that, only spent in the 70 billion last year. So it's growing quite aggressively here, the CapEx spend. The way we think about it is we want to invest in the enablers. Remember, we identify the big structural thematic, which is artificial intelligence, identify that it's going to be great and there's lots of use cases and it's going to go for a lot longer than people think. And then we try and invest in the companies that enable that structural change to play out. So really what we're doing, Bob, is we're investing in the bottlenecks of AI. So if you think about where that money goes, it goes to semiconductors. Mm-hmm. So semiconductors are a really, really important part of the ecosystem. So that's obviously companies like NVIDIA it is commonplace and known to most people on the call, I'm sure. But it also goes to companies like Broadcom, who make an alternative product to NVIDIA. It also goes to companies like TSMC. TSMC is Taiwan Semi Manufacturing Company. They are the ones that actually make the chips for companies like NVIDIA and Broadcom. So they're a critically important company, one of the most important companies on the planet in our view. They've guided their revenues to grow at 30% or close to 30% for the third year in a row in 2026 because they're benefiting so much from AI. It also goes, Bob, if you take that one step further, it also goes to other bottlenecks in building out this compute architecture. So what we need is really extremely well-credentialed and very fast networking equipment. So if all these chips are going to sit in the data center, they need to be able to talk to each other in a very, very low latency way, i.e. very quickly, to get those good outcomes that consumers and businesses want. So networking companies can play a role here. And if you look at where we've got exposure, networking is an opportunity that's really come up for us in the last sort of 6 to 12 months. And that's showing you an example of how our AI exposure in the portfolios has started with those big chip companies and moved into things like networking as well. And then the last and most obvious one that we just touched on is the need to power these data centers. Nuclear is a really plays a critically important role in our view. And we've seen companies like Microsoft and Meta do direct partnerships with nuclear energy companies to take nuclear power directly from those companies. And then we're also looking at companies in, construction of these data centers. So what companies provide the mechanical and electrical laborers to get all of this stuff done? Again, another bottleneck, another opportunity for companies to grow their earnings in a really sustainable way because they're backed by this big structural thematic and they help solve the problem that the big structural thematic creates.
Yeah. So you believe that there's very good runway?
We certainly do.
Runway. This isn't a 1-year flash in the pan thing. This is something that, what do you expect the life is? I was reading some articles about the 2020 bubble or the 2000 bubble, technology bubble, where, companies like Cisco were selling like crazy. Their revenue was really hot, but then all of a sudden everybody had bought everything that they needed and the market just collapsed because there's nothing behind. What is the life of semiconductors? Is that something that needs to be replaced down the road, or do we run similar risk?
Yeah, so it's a really good question. So if you think about it, what we would suggest to clients and to people thinking about AI is that the opportunity here is bigger than you think. If you think about scenarios where we're going to start doing drug discovery with using artificial intelligence, and Eli Lilly, the biggest pharmaceutical company in the US, has made a partnership with NVIDIA to start down this road. If you think about the scenario where, we're going to start buying and shopping through ChatGPT or Google Gemini, or maybe through Meta AI. If you think about the scenario where we've now got in the US, Waymo doing 35 to 40,000 rides a day in the US at the moment. All these applications are coming. They're going to come. And they're going to be used, we think, by individuals and businesses all around the planet. And so what that creates right now is a situation where the demand for compute power, compute infrastructure, significantly outweighs our ability to supply it. And now, because the opportunity is so big here, because those use cases are so varied and are so big and are so wide-reaching, we think the demand for compute power will outweigh the ability to supply it on a multi-year basis. And now bring that back to the stocks. Okay, so let's think about, are we in a bubble? The stock market, the Nasdaq was up sort of mid-teens in 2025. It wasn't up 102% like it was in 1999. Valuations of these companies, you can buy NVIDIA for just a small premium to the S&P in terms of the multiple you're paying for the earnings. You can buy TSMC at basically a multiple in line with the S&P 500. So we don't think the valuation argument is ahead of itself. We don't think that valuations are excessive for the opportunity that we've got here in front of us.
Mm-hmm. So outside, and we've got about a couple minutes just to sort of wrap up.
Yep.
We've really focused in on AI so far. What do you see other opportunities outside of AI?
Yeah, I'll give you one. So look, a big part of our portfolio, one area of interest is called digital media and content. Digital media is all about following consumer eyeballs. If you think back to Disney being one of those great investments for a long period of time, it was all about effectively circling the best content available in the market and having the eyeballs focus on that content. Mm-hmm. Now, fast forward to today, what we think is one of the best content opportunities out there is in live sports. So two stocks that we do have in the portfolios at the moment, the first of which is Formula One, the second of which is TKO. Formula One's an obvious one. I'm sure everyone knows that. But TKO, they are responsible for UFC and WWE. And so investing in sporting assets is really hard to do from a public equity point of view. But these two businesses we think are underappreciated relative to the ability to monetize these sports. Now, maybe just a quick anecdote in what that means. So if you think about what F1 is doing in Las Vegas, they are taking the operational control of the race. So they're doing more of the merchandising, ticketing sales, all the ancillary revenue opportunities that go with a race like what we see in Las Vegas. And therefore they're taking more of the upside, more of the earnings or the revenue share or the earnings share upside from controlling more and more of those other revenue opportunities associated with the Vegas race, for example. So these two assets have the ability to generate a far better earning stream going forward as investors and they start to appreciate the opportunity in these great content assets. And remember, the last thing I'll just say, Bob, is that when you think about an area like digital media and content, investing in Formula One and TKO is sort of totally uncorrelated to AI. It's totally different. It's totally uncorrelated to power and things like that. So totally different. So we're trying to find different opportunities for the portfolio outside of those pure technology areas that are really AI focused at the moment.
Right, because diversification helps you with risk management. So anyway, thank you for your thoughts this evening here. Good in the morning over there. So we're going to flip the switch over to our next guest. And, just because we're going to talk tax right now, rather than going international, we just thought we'd keep it local. Our speaker today is Milan Vukovic, who is I think, Milan, you pulled yourself away from probably family time this evening. Is that?
That's right. While Kieran was speaking, I was hearing my 2-year-old's bath time. So he'll be asleep by the time I'm done talking, which hopefully doesn't go for the rest of the people in this room when I'm through with my discussion about tax.
Yeah. Anyway, so Milan is a partner with Thorstenson's LLP in Toronto, where he frequently advises personal, corporate, and trust planning with particular focus on high net worth professionals, owner-managers, and their businesses. His practice encompasses aspects of domestic Canadian tax law. Today, he's joining us to discuss some trends in tax and possible changes in Canada that maybe what we need to be aware of. So jumping into question number one, so we stay on track. Can you, a lot of talk, I don't know that there's a lot of talk. Lifetime capital gain exemption isn't something that everybody is spending time thinking about, but it's still an important part of tax planning in Canada. What's changed related to the lifetime capital gain exemption recently?
Yeah, so just backing up, a lot of the times the initial conversation that we'll have with a client business owner is, great, I've been approached with a letter of intent, I'm looking to sell. How do I best structure my sale? And typically it'll be structured at least partially as a share sale. And there are two things that can happen on a share sale by an individual. They can realize a capital gain, which is taxed at top marginal rates of 27%, or they can realize dividends, 39 to 47%. So you always want to try to structure into a capital gain. And so on the sale of a certain type of Canadian company, you can realize a capital gain up to $1.25 million and claim the lifetime capital gains exemption. So it's a complete wash. It's there's no tax payable in respect of that capital gain. And so the lifetime capital gains exemption was typically relied on by, I'll say, small business owners, but there's no actual cap to the size of the business, and they can be quite large, to at least structure into a partial share sale and have a tax-free event up to the limit of the lifetime capital gains exemption. So it was raised to 1.25 million. This year, it's expected to be 1.275 million indexed for inflation. Mm-hmm. So historically, what if a third party came along and said, "Sure, I'll buy your shares," you could sell the shares of your business to their company, realize a capital gain, rely on the lifetime capital gains exemption, and not paying tax up to the available amount. But there were rules that said if the purchaser company was controlled by an arm's length party, essentially someone related to you, then you would have a deemed dividend on the sale across. So instead of having a sale where you're thinking, I'm going to sell, realize $1 million, not pay a single dollar of tax, you would get a deemed dividend treatment. And so that was considered for many years to be punitive because people could sell their businesses to third parties without punitive result, but they could not sell their businesses to a family member through a leveraged buyout, for example, if their family member was using a company. And so the tax policy didn't really align with what was desirable, which was people didn't necessarily want to be selling or disincentivized from selling the shares of their company, their businesses, to non-arm's length parties when they wanted to do an intergenerational transfer. So in 2024, the Department of Finance finally heard saw the writing on the wall, and they came out and they actually created new exceptions which allowed for people to now transfer shares to a company controlled by a related party, the next generation, family members, etc., and to still claim the lifetime capital gains exemption. And it allows for there's two streams of exceptions available. One is a transfer that it's described as an immediate transfer occurring within 3 years, and the other is a long-term transfer occurring between 5 to 10 years. And so really this new landscape allows us to now structure into intergenerational transfers of business where someone wants to make a sale to a company controlled by a family member and still claim the lifetime capital gains exemption. And that opens up a whole new world of planning, whereas before we would strictly say, look, if you're planning on transferring shares through a leveraged buyout to a family member, you're not only not going to get the lifetime capital gains exemption, you're also walking into dividend treatment, which is the worst of the three scenarios of no tax, capital gains tax, and dividend tax. So those are the changes that happened in 2024, and we're just starting to see now this planning be implemented because there are specific guidelines for each of these exceptions, and those exceptions have not been subject to much. They've actually been subject to no judicial interpretation. And so the tax community is now going through applying these rules, helping business owners affect intergenerational transfers in reliance on this new legislation and claim the lifetime capital gains exemption. So that's the biggest change that's happened in this area. And the lifetime capital gains exemption is one of the only or one of the few tax benefits available to every single Canadian resident when selling shares of a specific type of company. It has to be a Canadian company and meet certain other asset thresholds, but it is one of the most valuable tax benefits available to any owner or manager in Canada.
So it's really the 20% that gets 80% of the results when you're trying to save some tax money almost, right?
Mm-hmm.
Yeah.
That's right.
Yeah. So if we look outside of that, and that's very, very important, and thanks for sharing that, what other trends are we seeing in Canada related to tax?
Yeah, so last year was an interesting year because we had a new government come into place, and the government before that in 2024 had actually announced a change to the capital gains inclusion rate in Canada. There's a proposed change to the capital gains inclusion rate in 2024, and the change would have gone from a 50% capital gains inclusion rate, so you pay tax on 1/2 of your capital gain, to a 2/3 capital gains inclusion rate, so you pay tax on 2/3 of the capital gain you realize. And so this was announced in 2024 prospectively, and a number of individuals and businesses sought to crystallize gains at the current lower inclusion rate before this legislation would come into effect. And interestingly, last year when a new government came into power, it announced that it was going to it was choosing not to reintroduce those proposals, and so they never became law. And that's a trend that I think followed throughout 2025, which is there were actually no significant legislative changes announced that impacted tax in the way they have in the prior years. It was almost what wasn't introduced or what wasn't announced. And so we looked to other areas of what are things that you would want to be aware of if you were working as an accountant or lawyer in Canadian tax, or if you had a client involved in the Canadian tax net. And it's actually that there were a number of administrative changes by the Canada Revenue Agency. And the most important one I want to talk about with today's audience is changes to the voluntary disclosure program. And so last year, this is the voluntary disclosure program, by way of quick background, it's a regime administered by the Canada Revenue Agency that allows taxpayers with historic non-compliance to come forward voluntarily and essentially come clean. And in return, the CRA will reduce penalties and potentially waive interest as well on the amounts owing. And so historically, to be eligible to come forward to the CRA under a voluntary disclosures program, the application had to be voluntary, meaning that no type of audit, no investigation, no inquiry could have been initiated in respect to the subject matter of the non-compliance. But late last year, the CRA amended their voluntary disclosures program, and they essentially created two tracks: prompted and unprompted. And really, it's the prompted, meaning you have been notified of some noncompliance, or there's some investigation, audit, inquiry, whatever has been initiated in respect to the noncompliance, and the CRA will still allow you to come forward to present your case, to discuss the historic noncompliance, and will still grant you partial relief with respect to penalties and interest. So, notwithstanding that there weren't significant legislative changes last year, there was at least one very significant administrative change in terms of a tool available to taxpayers and their representatives to come forward and to disclose historic noncompliance as a way of avoiding late filing interest and penalties. So that was a significant administrative change. And with respect to your question about, what are the broader trends we're seeing here in Canada over the last few years, the key one that I'm noticing in my practice is reporting. So historically, obviously, you as a taxpayer, you file a Canadian tax return. You might have some information reporting requirements that you also have to file. But the way in which the Department of Finance appears to be pursuing behavior that they don't consider appropriate is by introducing reporting requirements for various types of taxpayers and activities. So by way of example, historically, trusts in Canadian resident trusts had certain filing exceptions. So they didn't have to file tax returns if they were dormant, they had no activity in the year, et cetera, et cetera. Now, new reporting requirements have been introduced that not only require these trusts to file returns, but more importantly, they also require them now to disclose who the various relevant parties are. So trustees, beneficiaries, protectors, et cetera, et cetera. It's a huge informational ask for many trusts and their compliance teams to manage. They've also targeted very specific behaviors. There's two sets of rules: the notifiable transaction rules and the reportable transaction rules. And essentially, what those rules require taxpayers and their advisors to do is that if transactions with certain types of hallmarks or descriptions occur, those transactions themselves need to be reported by all parties involved. And what's particularly concerning about those rules, and particularly the reportable transaction rules, is the penalties in those cases for a failure to report are not only assessable against taxpayers and parties involved in the transactions, but also advisors. So advisors can be personally assess penalties if they're assisting, implementing, advising a transaction that they do not report. And that obviously creates a real conflict of interest if you're acting as an advisor and you've got a client that potentially touches on one of these transactions, and there's a calculus of, well, the client may not want to report because they don't want to attract audit scrutiny, but at the same time, as an advisor, you don't want to open yourself up to personal liability. And so that's exactly what those rules, we think, that's the exact kind of conflict those rules were intended to create. So very specific transactions that are outlined by the Canada Revenue Agency or in the legislation itself trigger specific reporting requirements. And then finally, in Canada, we have something known as the General Anti-Avoidance Rule. And so what that rule says, in effect, is that notwithstanding that you have complied with all the technical provisions of the Income Tax Act, if we find that the result you've arrived at is abusive, then we are going to recharacterize the transaction in a way that we think is reasonable to get the result that we think is that we think is appropriate. And so the GAR has been historically applied by the Canada Revenue Agency in instances where taxpayers structure their affairs so that they don't fall outside of the specific rules in the Act, and yet the CRA thinks they've arrived at an appropriate tax result. And so historically, the calculus has always been the risk of doing a transaction that is potentially GARable is you might be on the hook for more tax, but really the cost is the late filing interest that you pay at the time that you get challenged and reassessed. So the real cost to taxpayers was the interest component. And amendments to the GAR are now, one of the key amendments to the GAR is that in addition to being subject to a recharacterization if a taxpayer loses under the GAR, there's also an option, there's also a penalty that applies to that amount. And that penalty gets turned off if a voluntary disclosure is filed. And so all of these rules are essentially geared towards providing the CRA with more information, more reporting, and the difficulty they make for the average taxpayer who is seeking to comply is they introduce extreme informational and legal hurdles in terms of costs, opportunity costs, information costs, in terms of complying with the ever-growing set of reporting requirements of being a Canadian taxpayer and undertaking certain types of transactions. So that's
just to keep on track there. Thank you for sharing that. Now we have CPAs online. We have individuals as well. If somebody wants to get in touch with you, you can either look you up or get in touch with us at Well Stewards, and we'll pass Milan's contact information on to you. So next speaker is so we're up against I was talking to Vikram Rajagopalan, a close colleague and friend, I would think, and I said, Vic, we're trying to keep this international. You're in Toronto. And he said, well, I can go to India if you want, and we can do it from there if you. So that's what we're dealing with right now is Vic's up at 5:00 in the morning. He's working with us over there. Vic is the president and founder of 2.0 Capital Partners, more than 20 years in the industry. He's done all kinds of things. Like Vic is our go-to guy. If we have a question about private markets, what's happening anywhere, we go to Vic first. So we thought it'd be a good thing to get him online here this evening. So, he's been pivotal in raising capital for private debt and equity investments. He works closely with individual investors in some of Canada's largest pension plans. And he's here today to discuss the evolving role of private markets in Canada. So Vic, thank you for getting up so early and making the trip over just to help us show off.
Thank you, Bob. And again, I would have thought that me being in India would be the center focus of international, but of course I got outshined by my friend Kieran there, who you happen to get from Australia. So I'm stuck in the no man's land of time difference, right? So thank you for doing that, and ultimately thank you for the first two panelists. As someone who started a business 2 years ago, having been an executive, there's no two more pertinent conversations to me than AI and tax and lifetime exemption gains. So actually, I don't know how your viewers found it, but I found it all very riveting to listen to. as well. And Milan, to your point, business owners, like as I start off, it's such a topic that, again, if it's simplified, it's so valuable. Anyway, I just wanted to let people know that.
Yeah. Well, we set up the agenda just for you, Vic. So it's yeah. But thanks for joining us. So far we've looked at public markets. We've looked at the Canadian tax situation. These are two areas that the individual investor is pretty familiar with. But you're really helping us today to focus in on private markets. And Wealth Stewards, we've been quite involved with you and the private investing. So just talk about private. What do you mean when we talk about private markets, and why should investors even consider making investments in the private space?
Yeah, thank you, Bob. And I think that is such the topic du jour right now. Ultimately, if you look back at private markets, initially what private markets mean are very simplistically assets and investments that are done outside of the public stock and bond markets. That is the simple version of it. So things like real estate, things like private debt, private equity that you wouldn't normally see in the public markets. That was the definition of alternatives and private debt. So that's what the institutions were doing for the longest time, because they were big allocators of capital, and they understood that they couldn't just be in the public markets because they wanted to have a lack of volatility. They wanted standardized returns, and they could really value their portfolios in the private markets. Fast forward to 10 years ago, or really probably around 2010, was when the average retail investor started to get, and when we talk about retail, we're talking about everything outside of pensions, start to get access to these private investments. And the reason for that was most portfolios on the retail side were 60% equities, 40% bonds. I mean, the meat of the curve, that's exactly where most of the portfolios lie. Well, the issue it wasn't on the 60% equity side, because ultimately, as Kieran would point out, there's ebbs and flows, but overall, the equity market tends to produce a lot of value for investors. The issue was the 40%, right? Which was bond markets were not delivering the returns that enabled investors to meet their long-term goals. And if bond markets were not able to do that, it put a lot of pressure on your equity holdings and forced investors to take a lot more risk. And so I think that is where, and the need for income also added to that as well. Income played a big part of it. And so that was why retail investors started to go in there. Things like mortgage funds, private debt, more than private equity. Private equity is starting to get a little bit more, but really it was the income play and the whole notion of taking some of your bond holdings and moving it into these private holdings, because they gave you stability and they gave you income that was substantially higher than what you would get in the bond market. So put it into perspective, and again, we'll talk more about risks, and I shared the stat with you. The average bond fund over the last 2 years has delivered just north of 2%. The average over the last 5 years has delivered absolutely nothing, just about above zero. Put that into perspective with the average private debt fund that is just north of 7%, and the average mortgage fund that is above 7%. So that has really, those that have invested it, devoid of the risks, have seen benefits of that income stream, and that is where it's played such a vital role. Now, we will talk about this, but there's obviously the caveat of risk and due diligence and optionality. But that really is where it has become such a big part of the retail portfolio, is really to supplement that income and your equity holdings in a portfolio.
Yeah, and that's the main reason at Wealth Stewards that we started to look at private investing is that bond yields are currently around 3.5. By the time you take some management fees at 3.5, it doesn't leave anything for the investor. But if rates go up, you're gonna see erosion of your capital as well. So we felt that when we approach firms like yours that we needed to do something different to try to generate returns. So it's been growing pretty quickly. the private side.
Yes, it has been growing, and again, with that came growing pains, no doubt. A lot of retail capital plowed into the alternative private space between 2013 and 2020, and I benefited from that, no doubt. But with it, obviously, like any asset class, came education, perhaps the wrong type of investor came in. There was all sorts of things that's happened, by the way, in every single asset class, be that from hedge funds to equities, anything like that in the infancy. Obviously, real estate ended up being the predominant asset class that people invested in for two reasons. That was really the asset class to which retail funds were created initially, and two, of course, for most people on this call, you had a sense that you understood real estate far more than any other asset class. It was considered safe. It was considered obviously the collateral of it all. So real estate continues to be a big part of that portfolio. What has started to happen, obviously, is optionality, infrastructure, private debt, lending to businesses, acquisition financing, using your money to buy businesses. You continue to have what is happening today is very good in the alternative space. I'm very bullish about it because ultimately what has happened with these growing pains is that there's a level of professionalism, due diligence, including firms like yours that have been at the real start of it, have also evolved, I think, in things like due diligence and the questions to ask. It's weeding out some of the weaker players. It will leave stronger players along the way. But what is now abundantly clear, the bigger American firms coming in, you get access to some names that ultimately you likely wouldn't in years past. So it continues to be incredibly popular. All it means too is that it also requires professional help, people in the middle between a direct client, an average retail client, and the alternative world, because there's a lot of questions in due diligence because on the front end, they all look and feel the same, as you know, Bob, better than anyone else. But on the back end, how those returns are generated, what are the risks involved, what are the capital, that is the most important thing to talk about because ultimately these are longer term relationships. There's illiquidity risk in it. That's why you get an illiquidity premium. So they cannot be thought of as short term investments. So you have to have a certain level of expertise going in because you're looking to keep it for the long haul.
Yeah, one of the things that we know is that if you invest on the public side, if you buy a bond, let's say it's Government of Canada, it's a provincial, it's a corporate bond, they're very liquid. If you want to liquidate that position, you could do it quite quickly. You talk about the premium, the liquidity premium or illiquidity premium.
Yeah.
Just talk a bit about that, Vic, is that you're really giving up something to get those higher yields.
So one of the things, again, a little bit of a plug for 2.0 Capital, a part of what we do is extensive amounts of due diligence on the managers that we represent. And a big part of that is not the return, but whether or not you're being compensated for that illiquidity premium. Some managers post bigger returns, but ultimately are in concentrated portfolios that's illiquidity premium. Some post smaller returns, but they're well diversified and the liquidity risk is clear. Today, as we sit here, there's, I think most of your callers know, the elephant in the room is that there's a big swath of funds that are currently gated to investors. So this gating word is becoming a lot more prevalent. They're stopping clients from redeeming. The reason for
just talk a bit about that because I don't think.
Yeah, look, ultimately, and again, I'm talking about Karen because he happens to be on the call.
It's restricting redemptions, right?
Yeah, restricting redemptions. Ultimately, in any investment, you go through stress periods and you go to non-stress periods, right? I mean, that is a natural fact. In the public market during stress period, it is a function of volatility. You could go down 20%, 25%, 30%. The financial crisis with a pit in everyone's stomach as soon as you're down 40 to 50%. That is what you take when it comes to volatility. The private market's answer to that volatility is restricting redemptions. That is the answer to it. In times of high stress, in order to manage the portfolios, it is prudent for a manager to restrict redemptions in order to manage that portfolio and keep capital preservation, because they're not in the public realm where they have to trade on a daily basis. So gating and restricting redemptions is actually a mechanism used to protect investors. And the question is not when are you going to gate, because or can you gate, because I'm remiss when managers talk about their non-gating I draw contention on the non-gating track record, because it should be a characteristic, not a flaw of most private managers. But what you do coming out of it is very important. Are you fixed? Because if done properly, and I've been a part of firms that done it properly, you manage the portfolio well, you get out of your issues, and you come out of it stronger and better. Yes, the emotions are completely different. I mean, when you're losing 40 to 50%, it's a real pit to your stomach emotional thing, but you can redeem at any point of time and take your losses and put it in the bank and you feel great. Restricting redemptions is completely different. Likely it leads to preservation of capital, but in the midst of it, the whole notion that you want your money and you can't have it, that is an emotional response as well. But that is something, again, I think given everything that has happened, investors going in today are better educated on those risks. And my firm and our 2.0, we focus a lot on that in terms of looking at every manager that we do and really quantify what their liquidity risk truly is. Because no matter where you are on the private spectrum, there is some iota of liquidity risk. That is why there's a reason why bonds delivered 0, and I'm talking about 7 and 8%. There's a reason for that. And a part of that is the liquidity of being in an illiquid asset and not having that daily tradable nature of it. And people have to just be cognizant of it. That's all.
Yeah. But when you're talking about 30% to 40% declines in a portfolio, it's almost in the same sentence you're talking about gating and restricting redemptions. You're talking about the 30 to 40% in public markets.
Yeah.
It doesn't really mean that if a portfolio locks up for a period of time, that portfolio, not necessarily, could be, but it not necessarily is that in trouble.
No, and sorry, and if I sort of what I was insinuating is that the public markets, as soon as you hit a stress point, or people perceive you've hit stress,
yep. And they can sell, but they can drive market prices down.
Yeah, private, and yes, my point being, if done properly, the manager executes on it properly, it should lead to very little to no loss of present capital, because the only reason you're restricting redemptions in the first place is to fix the problems at hand. And you should, if the strategy is correct, if you're in real estate, for example, and you're a real estate debt fund, you should be able to work with your real estate developers and your real estate developers and partners in order to get back that principal. If you're in a private debt fund, you should be able to work out with your companies. The problem is when the strategy at hand does not actually equal what has been told to investors initially. And that is where due diligence of the strategy, ongoing due diligence, is incredibly vital. And again, if I may, that's the plug for us. And you know this, Bob, with me, that is where I bring a lot of value is that ongoing sort of.
And you won't see Vikram's company in a portfolio, but you'll see companies that we manage where some of the firms that he represents are in the portfolio. But now it's time just to try to keep it on track. Early in the discussion, I mentioned that there is a Q&A button at the bottom. If anybody has any questions, please feel free to ask those questions. And
Bob, can I start with asking a question of my friend Karen here?
Yeah, absolutely.
Karen, you while you were talking about AI, I'm just curious. Obviously, employment is a big part of growth and everything else. Have you guys talked about what is the employment story going to be with the advent of AI? Where are all the jobs going? Obviously, you're talking about people not hiring. What's the end game here in terms of where the jobs are going?
Yeah, so it's a good question, Vikram. And look, when I sort of talked about AI, I would deliberately frame it in the sense that AI offers lots of opportunity, but also some issues and threats as well. So when you're thinking about employment, yes, there is probably going to be less employment or less job opportunities in certain industries that are going to be more adept or more suited towards AI playing a bigger role than it does today. But on the flip side, I think, we need to be careful that AI is just not just going to take every job out there. We also need to recognize that building, hundreds of billions of dollars worth of data centers requires a lot of electricians, requires a lot of labor. It requires a lot of plumbing. It requires a lot of mechanical services to be done. So there's lots of opportunity in that. So across our portfolios, we've got exposure to directly to companies that provide those labor services and do the groundwork and do the grid connectivity, that put in the conduits to house all the cabling that the data centers need. So yes, there might be some disruption threat down the track, and that's, we'll see how that evolves. But there's also lots of opportunities today where we're seeing employment be in significant demand for the build out that's happening. Maybe one anecdote here is that, Uber came along in sort of 2011, right? That's when it started. And look, it disrupted, it did disrupt the taxi industry. Now, a lot of those drivers are now working and driving on the Uber platform. And in some cases for better, in a better scenario where they can control the narrative, the hours, the time and that sort of thing, where they go, et cetera, et cetera. So there's always going to be innovation in this space, but at the moment I don't think it's a clear cut exercise that, yes, we're going to lose thousands and millions of jobs.
Yeah, I think
that's how we're thinking about it.
Yeah, I think the story there is that, does something like AI steal jobs? And the answer is, well, it creates jobs for people who learn how to use it. So that's, I think, where people should be turning their attention.
And look, one really last quick point here. The best way I've heard this explained is by Jensen, the CEO of NVIDIA, Jensen Huang. He said every job has a task and a purpose. The task can potentially be supplemented with AI, but doing the crux of my job is to generate good outcomes for clients, and yours, Bob, too, and the same for all of us. That's the purpose of the job. That doesn't go away. That can't be supplemented with AI. But the task, me filling out the Excel spreadsheets and modeling the companies and doing all those sorts of things, that can be enhanced through AI. That's sort of broadly, I think, a good way to think about it.
Yeah, no, perfect. So we have a couple of questions on the Q&A board here. Will data centers just be built, or will data centers be built using solar, or built in space using solar?
So this on face value, it's a good question, Michael. It's on face value, this might seem crazy to some people, but if you listen to what Elon Musk is saying, it's not that crazy. So this is his ambition. We don't have a strong view on the space element of this right now. I do have some thoughts on the solar side of it. So, and I think this plays into exactly what I was talking about with nuclear energy. So the reason why data center companies are adopting nuclear more so is because you've got continuity of supply, and you've also got high capacity factors at low emissions. I'm sure if Meta and Microsoft and Amazon, et cetera, could use more solar, they would. But the gating factors around solar are obviously things like continuity of supply. So you need to think about how to integrate battery technology to ensure that continuity of supply. And then you need to think about capacity as well. So nuclear has a distinct advantage there in providing high capacity factors to data centers, which is what ultimately these companies need. So as solar plus storage evolves over time, it will play a bigger role. But in the near and immediate term, I think high capacity and continuity of supply are the two critical issues there with power.
Yeah, perfect. Thank you. Now, I'm not familiar with the term in here, but as real estate continues to roll over in Canada, do you think that private MOCs are risky?
I think he was alluding to MICs.
Yeah.
More investment.
Do I take that, Dick?
Yeah, no, it's a really good question. For full disclaimer, we do represent a MIC that we just kind of took on as well after all of that, and was a big part of our due diligence. For everyone, the question is around mortgage investment corps. These are there's a huge bunch of them in Canada that focus on the residential market, financing people who want development of their homes or refurbishment or any of that kind, where they are business owners and they cannot get a conventional loan at a bank. And obviously, real estate has gone through its stress points and but the mix space, the residential Canadian mix space, has been incredibly resilient. In our research, we have found that the struggles have really been in the construction commercial space. The residential space has been fairly robust, and the reason for that is the conservatism of most of the bigger mix in the mortgage investment corp space at 50 to 60% loan to value. Having said that, that is why we've kind of looked at the space today and into the summer, because we want the rollover to this question. I think a lot of investors think that the issues happen at the point of time of the issue, which is when interest rates rose in 23. It really takes 2 years or 2 or 3 years for it to roll over. So you are starting to see some of those issues with higher leverage. So yes, to your investor's question, I would caution on anything that is using a large amount of leverage, because ultimately that is where the stress is. If you're at 80, 90% loan to value, you are feeling the stress. And if you've originated most of your loans during the height of 23, in the summer of 23, when interest rates were going up, it doesn't take a rocket scientist to understand that you're going through some of those challenges. So you want to see some of those rollovers. So the answer is you have to be cautious. But I have been in our research I've been pleasantly surprised at the resiliency of some of the bigger mortgage investment corps in this country. In this country, it hasn't faced the challenges that I thought that they would.
Yep. So it's just real estate has always been a great investment for people because of the leverage. Now that interest rates are low, and that the market has kind of gotten a bit soft, it's more difficult. So, real estate's there. Anyway, we're up against the clock here. Just in closing, thank you to our panelists today. We appreciate joining from Australia, from India, and from Toronto. So thank you for doing that. On behalf of all of us at Wealth Stewards, thank you to everybody who took the time to join us tonight. We really appreciate the panelists and everybody who logged in. We know that everybody's schedules are busy, and we could be out having fun in this lovely weather in Toronto tonight. Tonight's roundtable has been recorded, and we will be sending you a link shortly so that you can watch it again, or you can share it with a friend, maybe a family member, maybe a business colleague who might find it helpful. As you leave this session, you're going to see that our director here, Shelby, is sending out a short survey. Might take you about a minute to fill it out. We appreciate your feedback. It's really valuable to us as we try to plan these things and make them run smoothly. So just in closing, thanks to everybody for joining us this evening. I hope everybody has a wonderful evening.